prior to the discussion, Kenneth sent in an email, and I was maybe going to put some discussion into this, do some slides for this, and go through some quick historical details. We're still probably going to do that, but I didn't have full time to prepare a slide presentation. But Kenneth's question was, as you know, I've been doing deep-ish in the money weekly covered calls. And I have a tendency to roll the positions on Friday as opposed to letting them expire. Now, what Kenneth wanted to know are, what are the pros and cons, advantages and disadvantages of selling a 1 week out call and rolling it on Friday or letting it expire, or selling a 2 week call out to begin with and closing that covered call early. So closing it at the end of the first week, trying to get 50% of the profit if we pick the right market timing and that position was profitable. Now, I replied to Kenneth's email before the webinar, and I shared with him 3 different presentations where we discussed similar content related to his question about looking what are the pros and cons of doing a 1 week out position and letting it expire or rolling it versus doing 2 week out positions, or what are the pros and cons of doing a 2 week out position and letting it expire or rolling it versus doing a 30 or 40 day out position as well. A couple of discussions we had. I'm just going to navigate over to the YouTube channel real quick. I'm going to use the magnifying glass here on the Power Options channel. And the first thing I want to look at is to approach. I'm going to do a search for this to approach. And about a year ago, we had a discussion very similar to this, but it wasn't on covered call positions. It was on out of the money naked puts, and I believe it was from Kenneth as well. Let me make sure it doesn't start autoplay. There we go. And this discussion, selling puts to approaches, the question was, is it better to sell 1 week out and hold to expiration, or sell 2 weeks out and look to close early? Well, we start off reviewing the process for what we discussed on Power Options, the weekly naked puts, picks of the day, the monthly picks of the day, and the covered calls as well. We then looked at the theory of closing positions early for 50% of profit and why this might not meet your goals. Why wouldn't that meet your goals necessarily if we were looking to sell 2 weeks out in time? Let's say on a bull put credit, I'll get to that. Let's say in a naked put, I go 2 weeks out in time and I'm looking for a 2% return. I go 1 week out in time, same stock, same security, same strike price, and I see a 1.2 or 1.3% return. Obviously, a better annualized return going week by week as opposed to 2 weeks out or month by month. That's one of the advantages of using the weekly options. But if I sell a 2 week out position, if I don't get the right move I expected, or a neutral move even in an out of the money naked put, there's no guarantee I'm really going to get the 50% profit in that first time frame. So with a 2% return, I'd be targeting a 1% yield on the position. Or maybe for the monthly, we were looking at a 2.9 or 2.8% return. We might not get the 2% return in the 2 week time period where we were looking for a similar 2% return just the 2 week out. So we looked at that, why it might not meet your goals, and then we did back testing of a 1 week out naked put over the last month versus selling 2 weeks out and trying to close early. So remember, you can check that out. Just do a search for to approaches, selling puts, and a similar discussion, though it's not related to in-the-money covered calls. The conclusions and what we looked at there would be similar to what we would find with the in-the-money covered call, I believe. In addition to that, similar discussion I was just mentioning, 2 ways to trade a strategy, bull put credits. I'll make sure that doesn't start playing again. And in this discussion, a while back, a little bit more than 2 years ago, Jerry asked a strategy about another options educator that does bull put credit spreads that are 45 days out in time. Looks for a specific credit and looks to close the position for 20 to 25% of the maximum profit, to close the position early if that's reached. Well, our approach is usually to go 2 weeks out in time, following the bull put credit spread default search, the weekly bull puts, with 85% probability. what we found in this comparison, we reviewed our approach, we evaluated what Jerry told us about the alternative approach, and then we reviewed the pros and similarities and differences from each. And in that differences discussion, taking the same stock again, taking a similar position, 2 weeks out in time versus 30 days out in time to keep it almost even. Both trades were successful. The original 2-week out bull put credit spread was expecting a 14% return. The 40 or 35 day out bull put credit spread was looking at almost a 30% return, but closed early in those cases. If I let the 2-week expire worthless, we saw about a 14.5% return. And if we closed the further out option at the 20 to 25% of the expected return, it was actually closed a day or two before for only a 12% return. And then the argument is, well, in the old days, commissions would have mattered. They don't matter as much now, simply because the commissions have dropped so much since what they were 6 or 7 years ago. But you're adding an extra step. You're adding extra commission costs to your position. Now, sure, not every bull put's going to expire worthless to meet your goals. Sure, there's nothing wrong, and I can't fault closing a position early to achieve the profit, or a profit, I should say. But side-by-side comparisons, our conclusions in both of these discussions basically came down to, we feel it's better to do just the 1-week out position or the 2-week out position compared to a 30-day or 40-day out position, and let it get as close to expiration as possible, or roll it on Friday, as Kenneth mentioned, if you want to stay in the position, rather than doubling the time and looking to close it early. That's our general conclusion. That's our general approach. Doesn't have to be yours. Again, as I mentioned, there's nothing wrong with taking a profit early. But what I've seen historically, paper trading and actual trading, the concepts of closing positions early to increase the success rate. You expect, okay, let's say that you have a regular 75% success rate or 85% probability of success, usually hitting around 83 to 87% on average, with out-of-the-money bull put credit spreads. The positions that go against you just going 1 week out or going 2 weeks out still go against you in the half time frame if you're going double the time or 30 days out in time. The rate of the positions that move against you for uncertain markets, uncertain news, things you couldn't see in a stock chart, irregularities that came up with the stock during the first 5-6 days you were in the trade or in the market as well, those still go against you. It doesn't really increase the success rate of the positions. You don't automatically move from a 75% success rate up to an 85 or 90% success rate. You stay at about the 75, 76, 78% success rate, or with bull puts 83, 84, 85. You're now just taking smaller profit because you're closing a position early. Could it be the same as doing 2 weeks out? By that I mean at 0.8, 0.91% return. Could it be the same as going 2 weeks out in time with an out of the money or in the money covered call and closing it a week early as opposed to just doing a weekly? Possibly. But remember, the most rapid time decay, the profit that you're getting in your favor doing out of the money covered calls, out of the money naked puts, out of the money bull put credit spreads, usually happens in the last few days to expiration. It is not linear.